JBlog, March 13th, 2011. Big story today is Japan's horrible earthquake and its aftermath, which of course has a direct relationship to investing and trading. Here we have a story that the second nuclear power plant has lost cooling system, um, which I don't see too much of a problem in terms of an actual nuclear explosion like Chernobyl, but rather it will cause a severe power shortage in Japan and therefore hit Japan's GDP quite significantly. Now, Japan is a country that is already amazingly in debt, running way over 200% GDP, and it's probably the first country to fail to have to declare some sort of a default on their debts. Now, it's not going to be a full default, it's going to be a partial default, obviously. They are either going to print yen or they're going to have bondholders take a partial cut, like Argentina did. But in general, it's going to hit Japan because they will no longer be able to service their already way too high debts. And this just accelerated the inevitable. So that's going to be a big story that is coming up, and that accelerated things quite a bit from how long it would have taken otherwise. Market is quite irrational right now. Here, this run up on Friday, of course, is more buying to try to support the market, artificial buying. And the reason why this buying doesn't make any sense whatsoever is because Japanese companies will now have to pull out foreign investments and bring them back into Japan to fix things. And that's going to draw money out of the North American markets as well as the European markets, and therefore is going to put even more stress onto those markets than is already there. The market thinks this is good because we'll be rebuilding. I don't think it's good because we just do not have the money anymore to rebuild a major nation like that without hitting everybody else. So that's Japan and how that will interact long term on a trading point of view. You wouldn't be able to tell from the S&P 500's PE ratio still at 2363, very overvalued compared to historical norms. And last year, the big story was, oh, all of these companies will have amazing earnings and the PE will go down and everything will be wonderful. Well, those earnings did show up to a point, but they did not show up as significantly as they should. So it's not giving me the warm and fuzzies at this point. Shipping rates, Baltic Dry Index is starting to go up again here after a low in February. It's starting to go up. That either means that there is some capacity taken offline in terms of shipping, or the shippers simply got together and said, hey, listen, we're losing money, we have to do something, and collectively raised rates. Not that that ever happens, but you know what I mean. Um, so, anyways, shipping charges are going up, which hits us big time because most stuff is now imported from foreign countries, um, and therefore shipping charges going up will once again hit the consumer who already doesn't have money to start out with. The ECRI is potentially showing a bit of a topping action here, which would be topping out after a lower high. That be in line with a double dip. I might be the last person on the planet that still expects a double dip, but there will be a double dip in my world. Um, so simply because right now the whole thing does not make sense. There's an excellent article. If you ever have a chance to check out moneytalks.net, Michael Campbell does an excellent job um, at publishing interesting articles. This one is from John Malden, actually via John Malden, and it talks about simply the market being in denial over what is currently going on, and the whole thing simply being pushed by a massive injection of liquidity by all governments of the world, and how that's driving up the market, but that there's really no economic fundamentals behind it that are sustainable. Excellent, excellent article. I do suggest you do read it. That's again moneytalks.net. Michael Campbell, good guy. Always has something interesting things to say. You can listen to him on the internet as well. Okay, let's see, what else do we have? So the big story is Japan. Of course, everything else gets lost over that. Here was an interesting article I came across. Spanish banks are beginning to search for investors to plug $21 billion capital hole. Well, we got over that first disaster, and now, of course, these countries and these banks that are highly, highly over-leveraged are looking for investors to give them all this money. The problem is the governments have already used up most of the spare money that was around. And sooner or later, this is like musical chairs. There will be one or more people when the music stops that will have no chairs, i.e., no money, and then that's really when things fall apart. Greece, I believe, is now running. When they want to borrow money officially as a country, they will be paying 17% on that money. That is not sustainable. There's no way. Greece will have to default or be bailed out significantly by Germany, which is basically the only country that has money left over, and how long the German taxpayers will want to continue footing the bill, especially because the Greeks have been rather vocal about how they deserve all of this, and Germans really don't want to hear that, this entitlement society. Here's an interesting chart I came across. This is the median single family home price in gold. And you see how it has changed from the 1970s, where home price was very high compared to gold. Then, of course, we had a bump up in gold, and the house price went very low. And then, of course, the house price went very high in 2000 when gold was worth nothing. And now, of course, it has dropped off significantly. So, um, from a gold point of view, how many ounces of gold does it take you to buy a house? This looks very different from how many dollars or yen or euros does it take to buy a house. And you see a totally different picture here from the one you're used to when you look at dollars. Okay, let's look at some charts. First chart, of course, interesting is oil. Oil has dropped. Simply because 8% of Japanese GDP has potentially been affected by this earthquake, the following tsunami, and the industrial production that has been knocked offline. We don't know what a kind of an impact that will have, but Japan being a major user of oil, of course, take 8% of that off the market potentially will hit oil price. Um, so that's an interesting picture here, but it did have a breakout that was outside the regular channel, which been running for almost a year. So this was the Libyan crisis, Libyan Egyptian crisis, and there's a few more coming up on that part of the world. But that's going down again, so that does work in favor of the consumer, who will then have to pay less money for the gasoline to power their cars. And here we have the corresponding dip in gasoline prices. Still very high, but this could potentially come down again. Natural gas is not showing me anything. I did buy some natural gas somewhere down here because I said, well, it's too cheap. I like buying things that are cheap. I like selling things that are expensive. That's why last time I bought it when it was low and I sold it when it was high. That's good stuff. But it hasn't. It's not picking up. I'm a bit disappointed there. Um, Gold has had a bit of a drop off. Nothing significantly. Nothing to actually get upset about. Why is this not scrolling down? Here we go. It's just a minor correction here, but it's still within the channels. Um, and this is sort of a triple top here, so we'll have to see. I mean, it did break a little bit above it, not quite convincingly, so we'll have to see how that works. Silver is stronger than gold, and that is potentially because JP Morgan is potentially finding itself with a unsupported short silver position that now has to be covered at these prices. They are the biggest short seller of silver out there, and we see some serious deleveraging in this here. Here's the gold silver exchange rate. It's dropped down to 39 and a half. Naturally, as it comes out of the ground, it should be at 16, but even 10 to 1 is possible when there's a shortage. The US dollar is not showing us a lot of strength, but did have a little bit of a pickup here. Um, so something to continue looking at. I still have long-term option positions on UUP, just in case it does something massive. The VIX has been showing some strength here. I do find that people are starting to consider the possibility that perhaps not all is well, and we of course could have another breakout of the VIX here, which would be nice because I do have options on that. So that would be a good thing for me personally, and a bad thing for most other people. I do feel like a vulture sometime, but what can I say? Copper almost looks like a head and shoulders here. Copper could be going down, which says a little bit about the strength of China and the strength of India and the strength of construction in general. Um, and of course, a big story this week before the earthquake was that the New York Stock Exchange composite has broken support, which has been in place for quite a long time. So it's broken out of this channel. Is that anything to be worried about? Well, it could be because this market is highly overbought. This could be the beginning of something or not. As always, it's a question: how much money do they want to throw at it to keep it going? One last thing that I found interesting is here's the Commitment of Traders report chart for crude oil. And the very interesting thing about this is that, okay, there is the large speculators, and then there's the commercials, and those two usually work opposite each other. The commercials are the producers and the users of oil. Those are the actual people who know everything about oil. Speculators are usually momentum driven, and they're sometimes quite wrong. Now, these positions are interesting because these are historical highs. This is a massive, massive position in oil that the speculators have built up, and a massive short positions that the commercials have built up. The commercials are betting on oil to drop, and the speculators are betting on oil to rise. One of them is going to be wrong, and is going to have to cover their positions. Normally, the commercials are right just because they're on the ground, they are in the trenches, and they know usually better what's going on than the speculators, even the big speculators. Those are people who are, as I said, mostly momentum driven, mostly technical. And if this actually does, if the commercials are right, if the speculators are driven out of the market, they now have to deleverage. They have to sell off the positions that they have, which could drop the price of oil massively. And I'm talking massively in the neighborhood of 50, even $40 per barrel until this position is sold off and things make sense again. So there could be a massive drop in oil, even though the use has not changed at all. But it could very well be that we could have an eye opener here in the next few months. But things always take longer than you would expect them to. So that's all I have for today. So I'm keeping a very close eye on oil, and if it does look like it's topping out, then a short position on oil would be a possibility. and it seems like the insane thing to do at the time. So I'm always up for insanity myself. Um, but yeah, that's all I have for today. All the best and happy trading.